silver and platinum are among the few commodities that are trading up during the first week of the new year. And the head of commodity at Saxo, Ole Hansen, joins me to share his forecast. Thanks for your time today, Mr. Hansen. Now, is there really confidence that gold and other precious metals will rise this year, or are investors just piling into a safe asset class in anticipation of another year of volatility?
Well, I think actually it's a bit of both. There's no doubt that as you mentioned, we've seen a strong start for precious metals as opposed to some of the other commodities so far this year. And it is built on the view that this year will be more friendly towards investment metals compared to what we saw last year. Simply that some of the headwinds that we saw in gold last year, the strong rally in the dollar, the rising yields will start to fade. And with that, we are also dealing with the global economy slowing down. That may make some challenges, a challenging market for the equity market with earnings coming under pressure. And that basically means that with the technical picture at the start of this year looking quite favorable, we're seeing buyers already emerging in the markets this early on. I would be a bit cautious about the first move, but the general over the year, I believe the move to be right. I think we are going to see higher prices.
And just on that, you say in your latest analysis that there is a risk the market rallied too fast too soon and buyers should wait for a correction or a consolidation phase. When do you think this will happen?
Well, I've got a few gray hairs. I've been in this market for many years now, and what we normally tend to see at the start of the new year is a lot of uncertainty. And also, first of all, a lot of traders would like to worry about not getting involved in the right move. So basically this so-called fear of missing out is playing its part. But at the same time, the conviction among traders are pretty low, because you're entering into a position, you don't want to start the year with having a big loss by taking the wrong position. With gold in particular right now, we could still revert down to the lower 1800s without having changed the uptrend that we're currently in.
To the lower 1800s, but by the end of the year, what do you anticipate gold, platinum, and silver to be at?
Well, I think I'm fairly cautious. I mean, we obviously did put out outrageous predictions at the back end of last year, where we said the gold in an extreme situation could reach 3,000. I think it's probably we're more likely looking at the 2,000 to 2,100 area. So initially a move high of around 10%. Silver would be silver. I think will outperform together with platinum and copper, because we will see a recovery in industrial demand. I'll say especially out of China once they get out of the virus. So silver I pinpointed 28 as a potential target for that. That would be an increase of 17%. Platinum potentially even more in the region of 20%. So these are obviously very optimistic views, but we've seen. Again, I'll say pent-up demand, especially also from central banks underpinning the market.
So if we're about to enter a correction phase, when should we start buying these precious metals?
Well, as I said, the uptrend has been established now since the early parts of December. For that to be broken, we need to trade back below 1800. If we do that, that potentially could trigger an even deeper correction, because there will be some disappointment. But I think just keeping faith in the belief that the dollar will weaken and we will see a peak in rates, we will see a recession being a risk to other asset classes, then I think we will see that underlying demand return and be relatively strong and will drive prices high eventually. Also, as I mentioned, last year we had net selling from hedge funds and from investors, and while we saw strong buyers from central banks, I think this year we'll continue to see buying from central banks. At the same time, investors are likely to start adding to their exposure back into gold. And these two, together with jewelry demand, I think will be three forceful drivers for the price action later in the year.
And as you say, I mean, a sizable amount of this gold demand is from central banks wanting to reduce their dollar exposure. And you cite the World Gold Council, who put the official sector purchases at 673 tons, their highest full year since 1967. By how much do you expect central banks to increase their gold stock this year?
Well, what is significant about the number you just mentioned was that that was only for the first 3 quarters. So in just the first 3 quarters alone was bigger buying than any year since '67. So obviously we'll see an even higher number when we get the final figures for the last quarter. I think that flow will continue potentially at a reduced rate next year, because obviously central banks to a certain extent are also price sensitive. So if we did see a too strong a rally at the beginning of the year, then maybe some of that buying will be holding back. But generally, we are seeing this de-dollarization coming into the market. We are seeing the central banks accumulating gold at a record pace. I think that pace will be strong next year, potentially not hitting new record highs, but even at a lower pace, it will still be I would say sufficient to maintain a soft flow under the market.
Okay, thanks so much for your guidance today. Head of Commodity at Saxo, Ole Hansen.